As MENA governments adjust to the new oil price reality, infrastructure is a growing focus area for the project finance community. GTR spoke to delegates at its Mena Trade Finance week in Dubai to understand the implications of that shift.
The low oil price is a result of unprecedented oversupply in the market. The oil-producing states have announced that they are not going to be limiting for the foreseeable future their production targets, and therefore there is a clear demand for infrastructure to physically manage the logistics of handling that oil. There are projects happening in the UAE to propose infrastructure finance related to the logistics of oil. There's a great demand from players for new banking relationships. In the market, banks' risk appetites are in flux. Every bank is reevaluating what their approach to the energy sector will be. So it's an opportunity for both sides.
I think we're seeing a huge change in the region in terms of appetite for projects being led by the likes of Egypt and Morocco from a North African perspective, where we're seeing massive scale. I think that then is filtering through to the Emirates. We're seeing more and more project opportunities in Jordan, filtering on then into even right through to Pakistan. So we're seeing an increase in opportunities crossing our desks.
Despite lower liquidity in the region, it appears that viable projects haven't faced any issue in attracting finance.
We haven't been constrained from a project finance point of view on any projects in any of our markets. We do see some other projects across our desk which are struggling to source debt, but that's usually, it's more a project issue than a liquidity issue. So in terms of a quality asset, we find we'll always get it away from a project finance point of view, and we get it away with the level of gearing and pricing that would be required to make it work. Egypt is great from a scale point of view, and we're currently proceeding with 3 large-scale projects there and looking for many more. There's convertibility issues in terms of long-term on the revenue side. Obviously, with a large-scale electricity project, you have a revenue of up to 30 years, which has to be converted back to US dollars in terms of paying down debt and from an equity investment point of view. So that is an issue.